Have you noticed Treasury yields hitting 5%? If you have money in stocks, especially tech stocks, this matters to you a lot. And most people don't fully understand why. Let's fix that right now. A Treasury bond is simply a loan you give to the US government. In return, the government pays you interest, that's the yield. Right now, those yields are near 5%. That's the highest we've seen in over 2 decades. So why are yields climbing? 3 forces are pushing them higher right now. Inflation staying stubborn, oil prices adding pressure, and massive government borrowing flooding the bond market with new supply. Together, these forces are driving long-term borrowing costs to levels not seen in a generation. Inflation keeps bond investors demanding higher returns. Oil prices feed that inflation fear. And when the government issues more and more debt, buyers demand higher yields to absorb all that supply. Here's the chain reaction that every investor needs to understand. When bond yields rise, borrowing costs rise everywhere, for businesses, for consumers, for mortgages. Higher borrowing costs slow down economic growth. And when growth slows, company profits get squeezed. It flows like this: bond yields up, borrowing costs up, valuations pressured, and growth stocks struggle. Each step feeds into the next. Tech and growth stocks feel this pain most. Here's why. Their value is based on profits expected far into the future. When yields rise, those future profits are worth less in today's money. It's called discounting. Higher yields literally shrink the present value of future earnings. There's another force at work too. When a risk-free government bond pays 5%, investors start asking, why take the risk of owning stocks at all? That competition from bonds pulls money out of equities. And that selling pressure pushes stock prices down. On one side, a guaranteed 5% with zero risk. On the other, stocks that could go up or down with no certainty. For many investors, the math is starting to shift. Bonds are genuinely competing with stocks for the first time in years. For everyday investors, this shows up in your portfolio. Tech-heavy funds have underperformed. Long-duration growth stocks have pulled back sharply. And if you hold bonds directly, the market price of those older bonds has fallen, because newer bonds now pay more. Picture a retail investor checking their portfolio and noticing their tech stocks have dropped while bond yields are climbing in the news. This is exactly the dynamic playing out right now across millions of portfolios. So what could reverse this trend? 2 things would help most. If inflation falls convincingly, the pressure on yields eases. Or if the economy slows enough that the market starts pricing in rate cuts. Either scenario would bring relief to growth stocks. Here is the single most important thing to take away from all of this. Bond yields are not just a number on a financial ticker. They are the price of money itself. When that price rises, every other asset, especially growth stocks, has to reprice to compete. Understanding this gives you a real edge. Let's recap the chain. Yields rise because of inflation, oil, and debt supply. Borrowing costs rise everywhere. Future company earnings get discounted harder. And growth stocks lose their edge against the risk-free return of bonds. 4 steps. 1 powerful chain reaction. Bond yields at 5% aren't just a headline, they're a signal. And now you know exactly what that signal means. If this helped you see the market more clearly, share it with someone who needs to hear it. Because understanding how money is priced is the foundation of every smart investment decision.